Tether joined an $8 million KAIO round, pushing deeper into the infrastructure that moves traditional funds on-chain. Tether RWA matters because this is not a stablecoin issuance story. It is a bet on the rails that could distribute tokenized funds, expand asset classes, and make real-world assets easier to access through blockchain systems. That makes the investment a signal about market plumbing, not a claim that tokenized funds will instantly become mainstream financial products. The rails have to prove they can carry real products. That is the difference between strategic funding and practical tokenization adoption. KAIO says the new capital will support on-chain fund distribution infrastructure. That phrase sounds technical, but the idea is simple. Traditional funds need systems for access, settlement, ownership records, and investor distribution. Moving those steps on-chain requires more than minting a token. It requires plumbing that institutions can actually use. Distribution infrastructure is the unglamorous layer, but it can decide whether issuers can onboard investors, handle records, settle transactions, and support compliance at scale. Infrastructure becomes valuable when it removes friction for issuers. Without distribution rails, tokenized funds can remain isolated experiments instead of usable financial products. The round included Tether and Systemic Ventures, with KAIO's total funding reaching $19 million. Earlier backers include firms such as Further, Brevin Howard, and Karatage. The funding amount is not the only point. The investor mix shows that tokenized assets are attracting capital around infrastructure, not just around headline token launches. A tokenized asset is only useful if the legal claim, redemption path, and operational process behind it are as clear as the blockchain representation. Legal and operational clarity are as important as token design. Investors need to understand what they own and how they can exit. Tether RWA strategy is important because Tether already sits near the center of crypto liquidity through USDT. When the company backs tokenization infrastructure, it signals interest in the layer beyond stablecoin payments. The layer where funds, credit products, money market-style instruments, or other asset classes may be distributed on-chain. The funding stack matters because tokenization companies often need credibility with both crypto-native liquidity providers and traditional institutions that care about regulated access. Institutional credibility depends on both crypto rails and fund market trust. That blend is why RWA startups often raise from both crypto and finance investors. Real-world assets are traditional assets represented or accessed through blockchain systems. The value proposition is not magic. It is faster distribution, clearer settlement, programmable ownership records, and access to products that normally sit inside slower financial channels. The hard part is compliance, custody, redemption, and whether users trust the issuer and the structure. Stablecoin liquidity could become an important settlement layer for tokenized products, but that connection needs real issuers and real transaction flows to matter. The stablecoin connection needs actual settlement use. If settlement demand never appears, the infrastructure story stays theoretical. The risk is that RWA growth can sound bigger than usage. A funding round does not prove institutions will move funds through KAIO at scale. The proof would be named products, actual fund flows, supported asset classes, and operational details around custody, redemption, investor eligibility, and chain infrastructure. That is why custody, redemption, and eligibility are not side details. They are the controls that make tokenized funds usable beyond a pilot program. RWA products fail when redemption and eligibility are unclear. Those details determine whether a tokenized fund can survive real investor use. For Tether RWA, the next signal is whether KAIO turns the $8 million round into visible fund distribution products rather than broad tokenization language. If the rails attract real issuers and measurable on-chain activity, the investment becomes part of a larger shift. Stablecoin companies moving into the financial infrastructure behind tokenized assets. A strong follow-up would show which funds are distributed, what investors can access, which chains are used, and how settlement or redemption works in practice. The next proof is product-level detail, not broad tokenization enthusiasm. Product details would make the opportunity concrete for issuers, investors, and stablecoin liquidity providers.